Good afternoon. I'm Jim Haley, the CEO of Dividend Assets Capital. Welcome to our conversation today with Don Luskin. Don is the founder and chief investment officer of TrendMacro, a investment strategy and economics research firm. Our call today is specifically being held for clients and friends of DAC. Our moderator today is Marc Saurborn, our chief investment officer. As many of you already know, Marc is a phenomenal chief investment officer and will do a fantastic job today moderating the conversation and keeping the conversation flowing nicely. Thank you for those who have submitted our questions in advance, but please feel free to submit questions to us, to Marc and Don during the conversation today as well. Some of you on today's call may remember Don and his thoughts that he shared with us during our Low Country Wealth Forum held back in January. Since then, I'd like to think that Don has become a friend of DAC, and we appreciate him being available and hosting this call with us today as well. So a little background on Don. His 40-year career as an entrepreneur, executive, investment manager, and commentator has been built around his passion for the application of technology and innovation to the challenging of investing. He's been the economic advisor to 2 presidential candidates. He contributes frequently to the op-ed page of the Wall Street Journal and appears regularly in Fox Business News. He's the author of 2 books, I Am John Galt and the Index Options and Futures. His articles and commentaries have been published in the Washington Post, Investment Business Dailies, the Harvard Business Review. That's just a short list of many. My most intriguing fact of Don, the thing I enjoy most about his background, he's credited for trading the first stock option on the New York Stock Exchange. I think it was back in the early 80s. So historic indeed. Without further ado, I turn today's conversation over to Marc and Don. Again, thank you for attending, and I hope you enjoy the conversation.
Thank you, Jim. First, I'd like to thank Don for agreeing to participate in today's fireside chat with DAC's clients and invited guests. I'm really looking forward to learning more about your insights on all these upcoming topics. We've had this webinar on the calendar for a few months now, and I think the recent events over the past several weeks have made the timing of this discussion even more timely for today's participants. And boy, Don, we've had some great questions submitted by our clients, and I've done my best to organize them into some logical categories, like into the economy, politics, Fed and tax policy, the deficit, immigration, even climate change. So I don't know if we're going to be able to get to all the topics today, but I'll do my best to try to cover them all. I also want to add that since this is a fireside chat, is meant to be interactive. I encourage our audience to submit questions using Zoom's question and answer feature. Listeners should be able to access that feature at the bottom of their toolbar of the screen during the webinar. Again, I would encourage our listeners to continue to submit questions, and I'll do my best to do as many as I can during the time allotted. I also wanted to let everyone know that today's webinar is being recorded. So if you want to re-listen to today's discussion, we'll have a link on DA's website as soon as we can after today's discussion. So without further ado, we have a lot of territory to cover, Don. We'll start from the top. And I know this is a topic that we've had the most questions about, and that's the economy. So while I don't necessarily agree with his politics, James Carville famously said it's the economy, stupid. And there have been many signs the U.S. economy is indeed slowing, whether it's McDonald's, Starbucks, or even the latest unemployment report. Both consumers and businesses seem to be feeling the bite of inflation slowing demand. So since the Fed's last meeting at the end of last month, after which Chairman Powell stated, and I quote, "The recent indicators suggest that the economic activity has continued to expand at a solid pace, but job gains have moderated and the unemployment rate has moved up. The market's reaction has been starting to discount several rate cuts." So, I wanted to get your opinion. Is this irrational exuberance, to quote another Fed chairman, or do you think the market's expectations are valid and logical?
Okay, great question. Thank you so much for letting me be here, and thank you to all of you in the audience. Look forward to your questions. We have been in some form of a slowdown scare or a recession scare for about 2.5 years. And 4 years ago, when we were just coming out of the COVID lockdowns, we were in a depression scare because we were in a depression everywhere in the world. And things were so bad. We had an unemployment rate of 15%. You have to go back to the 30s to see that. And serious people, the majority of serious people, were saying then that we cannot recover from this. We just dealt ourselves too great a blow. And so happened, we took the exact opposite position, and that turned out to be right. We said that we would have a very exuberant, rapid, V-shaped recovery, just like we do after every recession. In fact, an even better one, because when you have a 15% unemployment rate, wow, think of the upside. If you get any improvement at all, it's going to be fantastic. And it turns out that it was. So now, just 4 years after that, we have, instead of a 15% unemployment rate, a 4.3% unemployment rate. That's a big improvement, isn't it? Except everybody's losing their mind because a year ago it was 3.5. So we're looking at two movies on one screen. Do you want to look at my movie and say we've gone from 15% unemployment rate to 4.3% unemployment rate? Great, we're in a boom. Or do you want to look at the other movie and say, oh no, we've gone from a 3.5% unemployment to 4.3. We're in a recession. Well, don't do either of those things. Put it all in context. Realize that a 4.3% unemployment rate is very close to the lowest for the last 50 years. I mean, normally people think of something like 5% as a normal unemployment rate when you're doing just fine. So, I don't take that as an issue. Now, when I think, Jay Powell, I have a lot of critiques of him, but I think he has it generally right here, which is that the economy is expanding. It just isn't expanding as much as it was when we were coming out of a depression. That doesn't mean it isn't expanding. So that's perfectly right. We didn't have an inflation scare over the last 4 years. That wasn't just a scare, that was reality. We had terrible inflation. We had the worst inflation since the 80s. And that was a problem. But you know why we had that inflation, right? It's because in order to get out of the depression, the government sent everybody $6 trillion worth of stimulus payments at the same time as the shelves of stores are empty. When everyone has an extra $6 trillion in their pockets and there's nothing to spend it on, what little there is to spend it on, the price is going to go up. That just had to happen. Well, that's all just worked its way through the system. That's all metabolized. That's over now. Inflation is basically back to target. Now, people don't feel good about it because I can show you the statistics, the real statistics that, the Fed has a target inflation rate of 2%. It's like, 2.5. Okay, fine. Well, the problem is the average price level of everything was 25% lower just 3.5 years ago. So when I tell you the comforting news that the inflation rate has come back to the Fed's target, well, yes, that is good news. We don't want it to be 9% like it was 2 years ago. But that doesn't erase the reality that we had a terrible bout of inflation that isn't getting reversed. Everything's just more expensive now, and it's always going to be. And it's going to continue to inflate from there at 2%. So we just have to take on board the fact that we have gone through an economic experience where we experienced a whole depression within a matter of months in 2020, recovered from it within 9 months, and have gone on to fabulous new highs in GDP, in productivity, in employment, in every metric. And so where exactly is the slowdown? Why are people saying this? Why do these recession fears keep haunting us? Well, we had a jobs report last Friday in which we added 115,000 jobs. Okay, well, that isn't even the lowest jobs number this year. The lowest one was April when we added 105. So we added 10 million more than that. And it was during a month when there was a terrible hurricane in Houston that probably took 50 or 60,000 payrolls out of the system. But everybody's just absolutely sure we're in a recession, even though we added more jobs than we did last April. For some reason, people just feel like it's worse. Oh, it's not. So how many jobs should you add every month? What would be your benchmark? How would you know when it was a good jobs report or a bad jobs report? Well, you just look at how many people there are in the country and how many of them can work. What does it take to work? Well, you have to be alive, so you can't be too old. You can't have died yet, and you have to be an adult. So let's say you're 16. Well, the adult still alive population in the United States grows by about 130,000 a month. Now, not everybody who's an adult and could possibly work wants to work. Some people are stay-at-home moms or stay-at-home dads. Some people are students. Some people are rich and don't have to work. There are all kinds of reasons why people don't work, other than economic hardship. So on average, about 60% of the population works. So what's 60% of that 130? I don't know, call it 90,000. So 90,000 is just what you should expect just for waking up in the morning in a given month. And we had 20% more than that. So is that a recession? No. It's just that I'm not sure I quite know how to explain it, except to say that it seems that there is a cottage industry it's a pretty big cottage. It's CNBC, it's Fox Business, it's the New York Times, it's the Wall Street Journal. It's not a question of conservative or liberal. It's just a question of the media. They are constantly trying to get your attention, and the best way to get your attention is to scare you. It's just as simple as that. And right now, there's nothing particularly to be scared of.
Yeah. I had a follow-up to that question. What do you think that the Fed's new sort of targeted neutral rate is now, given we're in the economy? Because if you look at the 2-year T-bill, it's sort of trading 150 basis points below the current Fed funds rate. So do you think that, that's what they're kind of targeting to get to a neutral rate? Do you think it's actually below that?
Well, just so everybody in the audience knows what this expression, the neutral rate, means. So the Fed meets every 6 or 7 weeks and determines the Fed funds rate, which determines short-term interest rates in the economy. And when they are afraid of inflation, they want that rate to be high. And if there was deflation, they'd want it to be low. If there was a jobs crisis, they'd want it to be low. If we were in recession, they'd want it to be low. Well, what does high and what does low mean? You have to have some idea in your head of what normal is, right? You have to sort of know what the bar is to know if you're above the bar or below the bar. And they call that the neutral rate. So the neutral rate would be the Fed funds rate that the Fed sets at every FOMC meeting every 6 or 7 weeks that they believe would make no difference at all. It wouldn't help or hurt inflation. It wouldn't help or hurt economic growth. It would just be neutral, hence the name neutral rate. So the Fed funds rate now is 5 3/8%. Every alternate FOMC meeting, so the ones in March, June, September, and December, they publish their famous dot plot, where they tell you what they think the Fed funds rate ought to be for the next 3 years, and then what they think it would be hypothetically in a perfect world, where we had just the right amount of inflation, just the right amount of employment, just the right amount of growth, sort of the Goldilocks world. And that's kind of what they think the neutral rate is. They think right now that's 2 3/4. And the Fed funds rate is 5 3/8. And inflation is back to target. And there's no particular crisis in the economy or the labor market, as I explained. So there's no reason for them to have tight policy to rein in inflation, because they've beat inflation. There's no reason for them to have loose policy because they need to stimulate the economy to get more jobs. Everything's just fine. So the Fed funds rate's at 5 3/8. The just fine rate is 2 3/4. They need to cut rates. It's as simple as that. And they've sent the signal that they're going to cut rates. Now, it's not their style to say, oh, well, we think we're neutral now, and we think the neutral rate is 2 3/4, and our policy rate right now is 5 3/8. So at our next meeting in September, we're just going to cut the interest rate from 5 3/8 to 2 3/4. That just isn't the way they do it. Maybe they should do it that way. But they just, I don't know, there's just a big institution with a big fancy building in Washington, D.C. with marble columns. So they do things gradually. So they're just going to cut interest rates 25 basis points at a time, 1/4% at a time, or maybe 0.5% here and there. And over the next year or two, they're just going to meander down to whatever they think the neutral rate is at the time. Now they think it's 2 3/4. But I'm going to assume this is kind of the spirit of your question, Mark. It's pretty clear to me that the Fed is rethinking what the neutral rate even is. So a 2 3/4 neutral rate has been appropriate for the last 15 or 16 years after the so-called Great Financial Crisis, when Lehman Brothers failed and all those other banks and institutions failed in 2008 and 2009. That was a long period that some famous economists like Larry Summers called the era of secular stagnation.
Mm.
So the neutral rate needed to be low because the economy needed some kind of stimulus for like 15 years. Well, it's pretty obvious it doesn't need any stimulus right now. Everything's just absolutely booming, despite the fact that their rate is twice the neutral rate. So they're looking at that and they say, wait a second, we started raising rates all the way back in March 2002. We were terrified of inflation. Remember, we said it was transitory and it turned out not to be. As an institution, we were terribly embarrassed. So we got, we got very aggressive. We had a lot of rate hikes in a big hurry. And Jay Powell said very frankly, there have been Fed chairs in the past of great courage, like Paul Volcker in the early 80s, who were willing to cause more than one recession in order to cure bad inflation like we had 3 years ago when they started. They were willing to cause a recession. They said so, but they couldn't. So what does that tell you? That tells you that a 5 3/8 interest rate isn't all that bad. It's not that far above neutral then, or we'd be in a recession. We wouldn't have a 4.3% unemployment rate. We have a 7.3% unemployment rate. So my prediction, folks, is that the Fed will start cutting in September. There's no emergency on. I mean, we've had some volatility in the stock market. They're not going to do an emergency rate cut before the next meeting. They're not going to do 75 basis points. They're just going to do this in an orderly way because we're not really in a crisis. But by the time they're done, they're not going to end up at the neutral rate that they think is the neutral rate now, 2.75%, because they're going to continue to upwardly revise what they think neutral is. This could stop at maybe 4%.
That high. That would be,
and that's not a bad thing.
Yeah, no, I
agree. That's
agree.
good news.
I
Because if
agree.
you're in a 2.5% world, that means you're in the emergency ward and you need a doctor.
Correct. And it's been an incredible, impediment to savers too, because they've really not earned anything on their money, haven't kept up with inflation. It's been, taking away from, those prodigious savers. It's been
Hey, Mark,
disincentivized.
I'm going to interrupt you because I want to make sure everybody heard what you just said. There is such wisdom in that. This zero interest rate world has gone on for so long, since 2008, that savers have just gotten dumbed down, and they're just used to the idea of having a bank account with Jamie Dimon where he gives you 1 basis point for the privilege of hanging on to your money for you. I mean, that's not fair. And so, sure, you can say, oh, we have higher interest rates, so now if I need to borrow money, I'm going to pay more. Okay, well, how about rewarding savers? Is there any reward for scrimping and saving, or should you just spend it all? Well, we have a normal economy back now where there's a reward for saving and a cost for borrowing. So that means that savers are treated fairly, and it means that borrowers have to actually use their head before they borrow. They can't do any dumb thing because money's free.
And I think that's a good thing long term for the structure of the economy.
You
We had a question come in from our participants on talking about the bifurcation of the economy between the upper end of the economy versus the lower end, which clearly they're suffering more from inflation. Do you expect that's going to continue? See a moderation in that? Do you think that it starts to bleed? Because you are getting some changes in consumer behavior, even in the upper end, at the margin, it seems. Do you think that kind of stabilizes where we're here, or do you think that persists and advances to include more parts of the economy?
Well, there's so there I guess there, broadly speaking, 3 ways it could go. It could either continue where there's a widening rift between the haves and the have-nots, where obviously the have-nots are much more hurt by inflation because there are 150 million households in America, so the bottom half, 75 million, and there's nobody on this call who's not in the top half, and probably everybody's in the top 5%. But so you're the lucky ones. But the fellow or the person who asked the question obviously has the awareness that that's a wonderful privileged position. Most people do live from paycheck to paycheck, and that paycheck just isn't stretching far enough to cover the inflation. Now, if you're a top 5%er, well, it's annoying, but it's not going to change your life, right? So, there is a difference that's opening up. So the one thing that could happen is, that inflationary trend of the last 3 years could continue, and that rift would continue to widen. And I think we would have, some kind of revolution in this country. Probably guillotines would be involved. Or it could just stabilize here. And that is actually where it is. So as I said earlier, whether it's the Fed or the Congress, which has stopped giving stimulus payments, or whatever it is you think caused this inflation, there are different theories. The inflation has stopped. It's just normal now. It's like it was for the 40 years before 3 years ago. And so on a going forward basis, that means that the differential harm that was done to the top 5% versus the bottom 95%, say, that's just a locked in sunk cost. That's just an injury. And it's not getting any worse. So, time goes by and pretty soon you just get used to it. And, 50 years from now, you're not going to even remember it happened.
Yeah.
But there's another way it could go. This is unlikely, but every once in a while in history, there's the opposite of inflation. There's actually deflation. And, big, PhD economists from Ivy League universities are trained to think that deflation is ever and always just a terrible, terrible thing, because very bad deflations were associated with terrible economic events like the Depression and the Great Recession of 2008 and 2009. But it seems to be a special disease of credentialed economists from Ivy League universities that they seem to not understand cause and effect. They're very good with Greek letters and formulas, but not so much with cause and effect. So they don't remember that it was the Depression that caused the deflation. It was the Depression that caused prices to collapse. It wasn't the fact that prices collapsed that caused the Depression. That's just ridiculous.
Yeah.
You can just see which came first. So if we don't have a recession now, but we had a little deflation, then all of these things would run in reverse. And it would be like, ordinary working people would go to the grocery store, and for the first time in 4 years, they would see the price of hamburger actually went down since their last visit. So you can say, oh, it's deflation. Won't that infect their expectations? And doesn't that mean that they'll wait a month because they think hamburger will be even cheaper? Okay, well, if you need to eat, you're not going to wait a month for your hamburger, number one. And number two, there's a reason why sometimes stores put things on sale. It's to make you buy more of it right now, not less. So after what we have just been through, where the price level has risen cumulatively by 25% over the last 3 years, that is a holocaust for ordinary consumers. And any relief from that would be fantastic. Now, the last month's CPI was deflation. Prices didn't go up in June. They went down on average, except for just 4 or 5 categories. I mean, important categories, but still, the majority of the consumption basket, which is 170 items, went down. I can tell you for sure that when CPI is reported next week for July, they report it in mid-August, it's going to go down again. Now, I don't know how long that's going to go on, but that's nothing but good news, man. That is nothing but good news. But even if our base case is that we're just back to the Fed's target for inflation, well, we took our hit. We had our pandemic, we had our stimulus, we had our inflation. There were good things about it and bad things about it.
That's great. So I take it you don't expect a recession in the next 12 to 24 months.
Well, by the time you're talking 24 months, that's a planning cycle where there's just so many opportunities for so many different kinds of news events that, I mean, I can't tell you that's not going to happen. I can't tell you that something that would surely cause a recession isn't going to happen. Like, I don't know, suppose we wake up one morning and China has bombed all the chip factories in Taiwan because they're afraid that America will get an edge in strategic artificial intelligence, and all the chips for that are made in Taiwan. Okay, well, you want to have a recession? Okay, you can have one. That's how you do it. So, can I promise you that's not going to happen in the next 24 months? I don't think it will, but it might. But there's nothing right now that is pointing to recession. Recessions don't happen just because the expansion has been going on for a while. The economy is not like a living creature that has a God-given lifespan. And when you get toward the end of that lifespan, like a dog or a cat or a human being, okay, well, you're just going to die pretty soon. It's just the way it is. Economies aren't like that. Economies have to be killed. Something has to happen. I don't know. You tell me what, I don't think anything's happening.
Yeah. I wanted to shift gears a little bit, kind of related topic, talk about your market outlook. I've had several questions about it, where we are in the current market cycle. I think you started to address that. And given the overstimulation by the Fed and rapid change in Fed policy rates, can we say, with any confidence, where we are in the quote unquote traditional economic cycle?
Well, let me ask you to put a sharper point on the question. Are you asking about markets or the economic cycle? They're not the same thing.
Well, that's true too. So let's talk about the economic cycle where we are, because it's very interrelated.
Okay. Well, let me that I can dispose of that fairly quickly. We are no longer in that period that we were in, say, from 2020 to 2021, where you're just having that fantastic updraft from the catastrophe that we were in this time 4 years ago. So we are now in a steady state economic growth pattern, and we will be in it until something knocks us out of it. Now, so I think, right or wrong, I can pretty simply dispose of the economic question. Now, what does that mean for markets? We have a situation right now where if you look at traditional metrics, like, say, forward price earnings ratios, you could say, okay, well, it's certainly, this isn't a level of, this isn't a value situation that would exactly make Warren Buffett salivate and buy everything. Quite the contrary. This is not a time for traditional value investors to get involved. Fair enough. I can tell you that there are just 7 stocks in the S&P 500 that, they're the real thing. I mean, they've contributed a lot to S&P 500 earnings growth. They're expected to contribute a lot more, a lot disproportionately more. So they have higher PE ratios than the other 493 stocks. So if you take them out, the magnificent 493 don't look wildly overvalued. They don't look anything like they looked in, say, March of 2000. That was just a damn bubble. There's nothing like that going on. So we have relatively high PEs compared to, say, the average over the last 50 years. And at the same time, compared to just the last 15 years, we have very high interest rates on money market instruments, on long-term bonds. And you can tell yourself a story that has some truth to it, that stocks and bonds kind of compete with each other for money. And it's sort of an auction. Whichever one offers you better prospects is, you'll overweight the one that you think is better. So if you had a 10-year treasury, which is instead of 4% where it is right now, if it was more like it's been for the last 15 years after Lehman failed at an average of 2.5%, well, at 4%, it's more competition for stocks, isn't it? Right? A 4% payoff is more attractive than a 2.5% payoff.
Mm-hmm.
And bonds are offering you, with no risk at all, 4%. And yet stocks are really expensive at the same time. So isn't that just a disaster? No, because it was just like that for the 17 years from 1982 to 1989, after the last big inflation was killed by Paul Volcker. I mentioned him before. Those 17 years of extremely high interest rates, where the average 10-year yield was 8.75%, very, very attractive compared to stocks. Those 18 years from 83 to 99 were the 17 best run of years in the entire history of the U.S. stock market. Because the 80s and the 90s were a boom. The 80s and 90s were the boom set off by the invention of the microprocessor, which started out in the PC. And then by the time that was done, by the time Apple had introduced the first PC and then IBM popularized it, by the time 17 years had gone by, chips were in everything. They had gotten so inexpensive and so powerful, there was just a chip in your credit card, and you didn't even ask for it. Now, do you remember what banking used to be like in 1982? You had to, there were no ATMs.
No, you're going to the teller to take
Yeah,
cash.
no, there was an ATM. It was called a teller.
Yeah.
and if you had a savings account, the good news is you're getting some serious interest on it. But the bad news is you had to make your deposit at the window with the teller. You had to wait in line. You had to, waste an hour of your day that could have been used productively. You gave that teller a little paper thing called a savings passbook, and she would actually rubber stamp it with rubber and ink. Oh my God, the edifice of modern finance, forget about Wall Street, what we consumers experience every single day, that's become completely unconscious. Our credit cards, and then the miracles that probably most of us know about but don't mess with, like cryptocurrencies. This has all been made possible by the revolution that set in the 80s. And so it started out with a PC. And what's an ATM? An ATM is just a PC tipped on its side with a slot in it. And so, and then of course it went on, and it's a cell phone, and well, now it's AI. Now, I'm sure there's great diversity of opinion and experience and exposure and knowledge in the group that's with us today about exactly what AI is and what it can mean. Let me assure you that this is the use of the microprocessor to end all uses. I mean, this is a transformative technology, and those Magnificent Seven that are kind of a monopoly on this technology, and they won't be forever. But the fact that they have had such an explosion of earnings and valuations and interest shows you how important this technology is. So, the most famous one of the Magnificent Seven is NVIDIA. I can't tell you that 5 years from now, NVIDIA exactly is going to be the dominant AI company. That's not the point. The point is that AI is going to be the dominant technology probably forever. Because when you think about it, AI is the last technology we need to invent. Because AI itself can invent all the rest of the technologies, and we can just sit back. I mean,
well, hopefully you're sitting back. You're not being overtaken.
No, I know you may very well be worried that it's going to be like that movie Terminator 2, and it's going to take over the world and trigger a nuclear war. Okay, I'm not going to rule that out, but come on. So you asked me if there'd be a recession, that would definitely cause one. But in the meantime, I urge everybody who has not done so, it's free, it's fun. Just go online, play with ChatGPT, play with the AI image making things like Dream Studio. You will be shocked at the experience. So my partner Tom and I, in the year and a half since ChatGPT has been available, have completely integrated it in our business, use it every day, and it has made us so much more productive. And that's the definition of a good technology, the one that makes you more productive. You don't want to adopt the one that makes you less productive, right? So, there have been definitely some things about the microprocessor revolution that made you less productive, like video games. Might be a really good example of that. But some people say social media are, and I appreciate that. AI is the thing, and so are stocks really overvalued? Maybe they're undervalued. Maybe we don't have the imagination to appreciate just how absolutely great this is going to be.
Yeah. There's a lot of people that are pointing to the analogs, with the internet in the early 90s. We're sitting here now kind of in the first inning of this transition. So, we're monitoring that too from our investment standpoint. And it's just, you're really on a precipice. But if you think about the normal cycle, this, always starts with the hardware, and then applications and processes get developed on top of that. And so we're not even there yet. I mean, we're barely scratching the surface. So it's really pretty incredible what could happen in the future.
Yep.
So we're working with that. We've always had the question, is AI going to make us obsolete in a couple of years, or anyone in the financial industry, we're going to have jobs. But
okay, may I just interrupt there for a second? Yeah, that's a really good question, because sophisticated economics types people, have always said, well, don't worry about technology and the fact that it puts some of those little blue collar people out of work. Don't worry, they'll find new work. Okay, now it's going to put us out of work.
Exactly.
So this is going to be a real test of our conviction.
Correct. Be careful what you wish for. We're all going to be working on clean jobs and working on windmills and solar arrays.
Right. Yep.
Um,
Yep.
I wanted to shift a little bit. We had a lot of questions about the deficit. I know you have a strong opinion about this. It's kind
Yeah.
of third rail politics. And, you know, both parties have kind of ignored it, although I think the current administration, to use an Olympic paraphrase, they're going for the gold here when it comes to excessive government spending. Do you think either party has the sort of fortitude to address the deficit, or do you think they keep just kicking the can down the road?
Well,
It doesn't
neither
matter,
part.
actually.
Well,
Does it matter at
it's.
all?
I think this is really. I think this is more of an observation than an opinion. I think I just defy anybody to say otherwise. That, the two major parties are simply afraid of having the conversation with the voters about what it would take to rein in deficits over the long term, because we know what it would be. We know where these deficits are coming from. Now, temporarily, they came from all the COVID spending, and that began under Trump, continued under Biden. It was a big bipartisan thing. Both parties were all for it. So it's not a question of liberal or conservative or Democratic or Republican. That was something that it was felt we had to do in the pandemic, and that added a lot to our deficits, and it accelerated, brought forward in time a problem we've always known we were always going to have, which is as the population grays more than it grows, we are going to have more and more liabilities to Medicare, Medicaid, Social Security, and other safety net programs, and it's just not sustainable. So the conversation you have to have involves some kind of pain, where you have to say, okay, we're going to moderate these benefits. We're going to say that you don't get to start collecting Social Security. You can't start when you're 65. You have to wait till you're 75. Because after all, the miracles of modern medicine, 75 is the new 65. So that's only fair. In fact, in the 1930s, when Social Security was created, the average life expectancy at birth in the United States was 35.
Wow.
And you got your benefits when you were 65. Okay, so they really thought they were fooling
That was a
you.
real shell game there.
Yeah. So, it just didn't turn out that way. Now, it's not like we've never reined in entitlement benefits before. In the 80s, before Alan Greenspan became Fed chair, he was appointed by Republican administration to head a commission to try to save Social Security, because it was imminently insolvent in the 80s. And they raised the retirement age, they cut back the profile of benefits, and they raised the payroll tax. They sort of like did it all. They took a little pain here, a little pain there, and it has saved Social Security until now. That's pretty good. It lasted 50 years. So, it's not like you can't do it. It's just for some reason, it seems that politicians were willing to have a more serious adult kind of conversation with the electorate back in the 80s than they are today. I'm not sure why that's the case, but I'm pretty sure we can all agree that's what's happening. So at the end of the day, we're going to have to deal with this. Now, I've mentioned cutting benefits. I've mentioned raising taxes. There is a third way. We could grow our way out of it. Now, that is not entirely without pain, because the debt we have, the deficits we have, the growing deficits we have, will take from that growth wealth that we could have kept without that.
Mm-hmm.
So that's not a free pass. It's just the least painful path. And as long as you're on a painful path, isn't growth always better? So what does it take to do growth? Well, it takes things that politicians kind of don't like. Just depends on which politician you're talking about. So if you're a Democratic politician, it takes cutting taxes and cutting regulations, and you don't like that. If you're a conservative politician, a Republican politician, it means opening the border and let lots of young workers from other countries come in and expand the economy. They don't like that. So we have all the answers to doing it the least painful way. Nobody wants to do any of them, not even the good ones.
Do you think that either administration is going to try to reduce the deficit either through spending cuts or increases in taxes? I mean, there's been a lot of talk, regardless of who wins in November, that we're going to need to reduce it. I saw a statistic that said sort of 3/4 of your tax dollars are now going to service the federal deficit. I don't know if that's correct or not, but
Right.
certainly
Well,
it's a
that is
bigger,
correct.
bigger
By the
bill.
way, that service means that ordinary savers, like the people on this call, are receiving interest checks. So one man's debt service is another man's income.
Sure.
So that was to your point earlier, and don't forget that it's not an unalloyed bad that there are these interest payments.
Mhm.
But to answer your question, neither party is talking about cutting benefits. They fall all over themselves to say they won't.
Mhm.
Republicans say they want to cut taxes. Good for them. Democrats say they want to raise taxes, but they don't want to raise taxes to narrow the deficit. They want to raise taxes so they can spend more. So, unfortunately, the current political menu that's being served up to us in this political restaurant doesn't have any wholesome food in it.
Yeah. Do you think that, we talked about the Tax Cuts and Jobs Act, or quote unquote, the Trump tax cuts. Do you think that that's allowed to sunset and they bring out a new plan that maybe isn't as progressive on tax cut policy? Or do you think that, if there's a Republican administration, they just extend the existing program?
Well, if there's a Democratic administration, they definitely won't.
Yeah.
There are, first of all, there was a very comprehensive set of tax policy changes in that 2017 bill, some of which were tax hikes and some of which were tax cuts. So the one that was a tax hike, and it depends on where you live as to whether it was a tax hike or not, was they put a $10,000 cap on the deductibility of state and local taxes. And at the time, I kind of did the math, and it turns out that if you live in so I left property taxes out of this calculation. You can't do that because that is important. But just from an income tax standpoint, if your state has a tax rate 6.9% or higher, then you actually had your taxes raised in 2017.
Hmm.
So, I'm talking to you from Texas.
Yeah.
So I don't care about the cap. I got a zero here, man. So,
in South Carolina, I think
so
we're on the
I had a
ball.
tax cut. Now, so that $10,000 cap on the deductibility of state and local taxes, the abbreviation state and local taxes, SALT, SALT, that sunsets too. So there will be tax increases at the end of 2025 as you enter tax year 2026. The top rate will go back to 39.6. The state exclusions will snap back to double where they are right now and a bunch of other things. But you will get the deductibility back. So Democrats are definitely going to, want that part to sunset, right? Because the Democrats are, let's be honest. I hope you don't think this is a prejudiced thing for me to say. The giant democratically dominated states like California and New York and New Jersey and Massachusetts, they tend to be high tax states. Now, there's another very important dimension to this. The corporate part of the tax code that was changed in 2017 does not sunset. So the corporate tax rate was moved from 35%, the highest in the world, to 21%, about the average in the world. That's forever. Or at least it would take an act of Congress to fix it. It's not a sunset where it just happens automatically. So if you wanted to raise the corporate tax rate for any reason, you would have to have the House, the Senate, and the presidency all of the same parties so they could all vote on the same bill and get it signed. Now, I don't think this is a very heroic prediction, but I'm going to make it anyway, and I don't think there's any chance that it's wrong. The way that the Senate contests this year are laid out, which states they're in and which states they're not, there's just simply no question that whatever else happens in any other election, in any other office, Republicans are going to end up controlling the Senate. So that means that if Kamala Harris is elected president, and according to her rhetoric, would like to raise the corporate income tax, she's going to have to get that through a Republican Senate for at least the first 2 years. It's just simply not going to happen.
Yeah. So that's going to be
lowering the corporate tax rate was the most economically powerful thing they did. The rest was trivia.
Mm-hmm.
So the important thing is permanent.
Yeah, it's interesting. It doesn't sunset, so that's important. So
yeah,
I guess
really is. That's your safety valve.
Yeah, kind of shifting the discussion, I think, to your favorite. We talked about it in politics, upcoming election. Maybe just, maybe give some of your thoughts, what you think the impact of either a Harris or a Biden administration would have on the markets. And there's a question also, we had a question about, do you think that either political party had an impact on the recent market sell-off.
Okay, I'm going to start with that last one first. It's a very complex question. It's tempting to see the sell-off coinciding with the sort of vanishing into the mists of the seeming certainty that Trump was going to get elected. So you could tell yourself a story that, oh my God, the market wants Trump, the market doesn't want Harris. That might be true, maybe. I certainly don't. I don't think it's that simple. I don't rule it out. What I think has driven this correction that we've had. By the way, let me interject. It's just a correction, folks. I mean, I've got 122 clients, and they're the smartest, most experienced, you would think, calm people in the world. I've been getting questions about the crash of 1929. I mean,
Wow.
people are freaked out. And from the very top tick in the S&P 500 3 weeks ago to the very bottom tick on Monday, it hasn't even been 10%.
Yeah.
Oh, come on, everybody. Get a grip. Right? so I just want to get that out of the way. Now, we have spent the last 7 years as a people in the United States sitting in a movie theater together, all looking at the same screen and seeing 2 different movies on one screen. So half of us have seen the movie that says that Trump is Hitler. The other half of us have seen the movie that Trump is the friend of the little guy and he wants economic growth and everything's fine. Thursday night, June 27th. Everybody remember what happened then? For 90 minutes, there was a debate between Donald Trump and Joe Biden. And for the first time in 7 years, all 350 million of us for 90 minutes watched just one movie on one screen. And it starred Joe Biden, and it wasn't so good. And for half of America, who, at least during the Biden presidency, have told themselves, oh, this guy's just completely fine. So, the most comedic version of that, and, please, I hope any Democrat who might be in the audience doesn't think I'm making fun of them, because that's not the spirit here. But the extremely liberal New York Times columnist Paul Krugman, the day before the debate, published a column including the statement that Joe Biden is sharp as a tack and he's going to do great in the debate. Yeah. Well, literally 24 hours, he's saying he must stand down. So what happens is when half of America realizes, oh my God, this has been hiding in plain sight. It's kind of on me that I just didn't let myself see this. Well, that puts you in a state of mind that's like that wonderful state of mind you have like when you travel. I mean, you go to a strange new land where people, all the streets are different, it's a different language, and it's like all your presuppositions, all your autopilot stuff goes away, and you're like a child seeing the world for the first time, and it's magical. It's stressful, but it's magical and wonderful, and you're open-minded about everything, and everything seems fun and magical. Well, in a way, that's what happened on the night of June 27th, where we stripped away all our autopilot stuff that actually controls us 99% of the time every day. And we saw the world fresh. And once you've opened your mind to seeing the world fresh, you question everything. You don't just question Joe Biden. You question NVIDIA. You question everything. And so let's say that, keep with my analogy that you're traveling. So you go to some place like, I don't know, go to Greece or something, and you're there for 2 weeks. That magic wears off by the end of the 2 weeks. By the end of the 2 weeks, you're on autopilot again. So, I'm not saying it's 2 weeks for the stock market, but we're going to get back on autopilot again. But we had to have a correction because great bull markets, like the one we're in now, work really better when you don't think too hard about it.
So you don't
we've just gone through a
overanalyze.
period of thinking really hard, and it's not good.
Yeah.
Now, so as to whether the stock market's telling you anything, right now I actually think that's all it's telling you. And the reason I say that is because Trumponomics and Harrisonomics, they 2 different portfolios of economic policies, and within each portfolio, there's the stuff they say that they couldn't possibly do, and the stuff that they might do.
Yeah. Well, it's interesting you bring that up because I think nobody really knows what the Harris economic policy is because they haven't posted anything to the website. There's really nothing
Right.
out there yet. So
Yeah.
maybe that's
Well,
intentional.
and
Or
she,
they're still formulating.
she's what little we have heard from her involves backpedaling considerably on things like banning fracking that she said many
Yeah.
times. But I do, she made the statement, I mean, since her nomination, that she would not just let the 2017 tax cuts expire, but she would proactively repeal them
Yeah.
on her first day in office.
Mhm.
Somebody needs to tell her that the president doesn't just step into the Oval Office and repeal laws. That's just not a thing.
Well, Joe Biden's done that with,
Right.
presidential.
Now, Trump, on the other
Yes.
hand, says he wants to deport 20 million illegals, which would mean that you're taking 7% of the US population out, which means you're taking 7% of the US economy out, which means you'd have a depression. So, that's just, so he can't do that either. Somebody needs to
Mhm.
tell him that there aren't enough little green soldiers to, to figure out how to do that. So both of them are saying these symbolic and completely diluted things. And I'm sure they both know they're just talking, and the people who are deluded are the listeners actually. But there are also things that they say seriously that they want to do, some of which are good and some of which are bad. And I can tell you that Harris would, I think, I mean, you're right, she hasn't posted it on our website, but she would certainly let most of the 2017 tax cuts that are going to expire. Now, I can tell you, I've just done the numbers, and I can tell you that with respect to this tax cut, Arthur Laffer was right. They have paid for themselves. They have. They're paying for themselves every year. We're making 350 billion more in tax receipts this year at the lower rates than the Congressional Budget Office said we'd do at the higher rates. And I've done all the inflation adjustments. So why would you mess with that? Why would you mess with that? Especially if you want more government revenues for more social programs and more solar arrays and windmills and all the things that Kamala would like to do. Don't you want more revenues? Well, if you want more revenues, don't raise taxes. That'll hurt your revenues.
Yeah, sure.
Well, now on the other hand, Trump, so forget about the deportation. He says he wants to seal the border. That he can do. You can't round up and deport 20 million people. You can definitely, pretty much seal the border. You can get it at least sealed back to the way he had it sealed when he was president. There are all kinds of arguments for why one would want to do that. And some of his arguments for doing it about rapists and murderers are just exaggerated. And some of his arguments about, vetting people and having the rule of law at the border, because the rule of law is a good thing. Okay, I'm with that. But from a sheerly economic standpoint, the arrival just over the last 2 years of almost 4 million immigrants, say 3/4 of whom are illegal, has contributed tremendously to growth because we have the statistics and we know how many of them are working. Remember I said that 60% of the population is working? 60% of the new immigrants are working. So it's not like a bunch of ne'er-do-wells have come in and polluted the economy. They're working as much as anybody else. So over the last 2 years, if the border had been sealed, you would have had to take off 65,000 new jobs on average for 24 months off of every payroll report. That's terrible. Don't do that, Mr. Trump. Right? So I've got my long list of don't do that for Harris and for Trump. So which one, so just forgetting about the politics, just as an economics guy and a markets guy, which one do I want to be president? I don't know.
What do you think? I mean, kind of bringing that. What do you think is most likely scenario here? Because they're not going to deport all those people, but they also don't want to reward, bad behavior because there's plenty of people who've been waiting for a green card in this country, and the lottery system is extremely onerous, long, and
I know.
very frustrating. So, do you think there's a
You're
meeting of
absolutely right, and
minds?
you've homed right in. So I'm making just a cynical economic argument, and you're making a principled moral argument. And the nice thing about principled moral arguments like yours is that over time they do converge on economics. Because if you corrupt the rule of law, you corrupt capitalism. Because capitalism depends on a shared rule book that we all respect. Capitalism is this fantastic blend of cooperation and competition. We cooperate in agreeing on a rule book. And once we've agreed on the rules, we play a hard game. So we have to have that rule book. And the border corrupts the whole idea of rules. And pretty soon you got people taking shots at presidential candidates.
Yeah.
So not good, not good. So wouldn't it be easy just for the two parties to agree on how many people we ought to bring in under what conditions? Yes, except it is such a good issue to run on in elections, nobody wants to solve it.
Yeah. It
So,
gets the
there are, 4
bases
or 5
motivated.
issues like that in American life where, abortion is the other one. Easy
Yep.
problem to solve. Nobody wants to solve it.
Yeah. I want to shift a little bit, talk a little about commodities. It's been a topic, we have energy midstream investments here.
Mhm.
Certainly, the U.S. has become sort of the margin supplier, both to Europe and favored nations. Hopefully that continues.
Yeah.
Energy, renaissance going on. Maybe talk a little bit about what you're seeing. Expectations are, from a, global commodity standpoint. It could be related to oil prices. Also, we talked about a commodity super cycle, some weakness in China right now, but if we really wanted to work through this energy transition, we're going to need a lot more in the way of copper and some rare earth metals to be able to do that. So do you think that we're kind of on the precipice of that? And what do you think kind of longer term, what, from a hydrocarbon standpoint, what end demand looks like?
Well, we get better and better at all industrial processes as time goes by. We get more and more efficient with it. Uh, so yeah, you can point to demand factors that argue for copper or rare earths, or the list of 100 things you could have said there. Um, this isn't just a demand thing; it's a supply thing, though.
Yep.
And supply does arise to meet demand. And the more demand there is, the more supply there is, and the more supply there is, the more incentive there is at getting better at supplying the supply. So it's not obvious to me that just because you can make a demand case that you are necessarily making a secular case in favor of commodity prices. It has not worked out that way over history.
End demand. Kind of switching a little bit, talk about the global economy. U.S. has been kind of the preeminent economy for the past several years. Certainly, the financial markets have outperformed. Do you think that continues on a relative basis? Do you think there are other areas of the market, that might look more attractive over time, or that you would think about, getting reengaged or investing in?
Yeah, man, it's a really good question because the run of U.S. market dominance, it's just uninterrupted year after year after year after year after year. And I think it has a couple of, parents, that have given that were the result has been this child. And, one is in the financial crisis of 2008 and 2009, we were really the only economy that cleaned up its banking system. And we had to swallow hard to do that. And we did it, and it's really paid off. And the other thing is, whatever you may say about increasing regulation and intrusiveness of government and stuff, there is something about the United States that makes fundamental innovation always start here. And whatever there is in other countries that's like our tech giants, like, so China has its own Google and its own Facebook and its own, but it didn't invent them. It didn't get there first, and they're only used in China. No, only in China. Well, China's a really big economy. So, it's not like they're unsuccessful companies. And if you were Facebook, you'd rather be able to do business in China and not be crowded out by, whatever the Chinese Facebook is. But American innovation completely dominates every other country, dominates Europe, dominates Japan. So we, for whatever reason, we appear to have an ecosystem or a hatchery or something for innovation that is just the rest of the world can't equal. And unless something changes that, which would require, for it to happen in a good way, it would require the rest of the world to start doing better. Well, the rest of the world is just doing worse. Look at the crazy restrictions on technology development that the European Union puts on everything. Well, if you have some new idea and you want to, God knows what the next Facebook would be, but if that idea occurs to you and you're in Paris, you'll come to San Francisco to do it.
Sure.
Right. Until further notice, yeah, we got this thing, Mark.
Well, that's reassuring to our most of our clients, and I would agree with you on most of those points. We had a couple questions actually about climate change, its impact on the U.S. economy. Do you think it matters which administration is in office, how that gets rolled out? Do you think that there's some validity where do you have a long-term investment thesis on that? Is it something that investors should be thinking about, given the fact that most companies, at least Fortune 500, are really kind of, maybe peer pressure, have other SEC disclosures. They've really kind of adopted, kind of self-reporting all their sort of ESG, factors.
Well, so there are two dimensions to it. One is just the reality. So forgetting, are we in fact facing a world of, there's always climate change, always has been. But when people use that expression, they're talking about a secular trend over the next century toward global warming that is going to, change weather patterns and sea level patterns and blah, blah, blah. So everybody knows the story. Even if you take, say, sort of the gold standard of climate scare stuff, which would be that, UN report that they put out every couple of years. Part of the UN report is making an assessment of what the economic impact of it will be if you do nothing over the next 100 years. It's so insanely trivial. And that never gets reported. So these reports have, 500 pages or something, and, the media and the advocates pick out the 400 pages that sound like they're bad news. But then when you get to the end and say, does this make any difference to global GDP 100 years from now? The answer is, yeah, well, global GDP will be 10% lower 100 years from now than it would have been without climate change.
Yeah, but
really? Do you know how nothing 10% is over 100 years?
Yeah.
Right. So what that means is, if let's say that's true, I don't know that it's true, but let's say it's true. I don't know how anybody can tell you what's going to happen in 100 years, but let's say it's true. Surely it is the case that if there are winners and losers along the way, so if you're in the low countries of Europe, if you're in the Netherlands and your whole country's below sea level, it's like a whole country that's like New Orleans. Okay, so that you'd think that would be a loser from rising sea levels. Well, they kind of figured that out about 500 years ago. And if they have to figure it out again, it's going to cost a couple $1 trillion. But how many trillions is it going to cost to prevent an economic revolution that would lift 1 billion Africans out of poverty into the 20th century? Because, we can't let them have a middle class life because they'll have to industrialize and it'll cause global warming. Okay. Do you realize that you have just consigned 1 billion Black people to a century of poverty?
Yeah.
That's just what went along with your prescription. So, don't do that, right? So let that 1 billion people have the life that we live now and spend $1 trillion building a wall around Amsterdam. That's the answer. That's the answer.
Yeah.
So the problem with global warming are these ridiculous efforts to ameliorate it or keep it from happening when, again, you go back to that UN report, which they always say is the gold standard. That UN report says this is all just locked in. There's nothing you can do about it. You can stop oil refining and all that stuff. It's not going to make any difference in the next 50 years. This stuff is just locked in. So why shut down growth? Why promote poverty? There's no better way to lift people out of poverty than to let them have access to energy. Because right now, there are 1 billion people who heat their homes with wood and dung. And that is not good for their health. And it's not a good carbon footprint either to burn wood because you're deforesting, among other reasons. So, this is all just completely.
But we have to get rid of our gas stoves and hot water heaters. Because somebody said so.
And hopefully we feel terribly noble to have made those absurd sacrifices.
But we're not sure.
So my bottom line, my slogan on that question is, the worst risk of it is that we do a bunch of stupid stuff because there really is no economic risk except the self-imposed unnecessary sacrifices.
Or bankrupt ourselves chasing Don Quixote sort of
Just chasing ghosts.
objectives.
Yeah.
Yeah, that's great. We're a little bit over time right now. I mean, I think we slated about an hour for this. So I want to thank you and everybody else for participating in today's webinar. Like I said, as I mentioned at the beginning of the discussion, we're going to be recording this fireside chat, and we're going to be having a link to that on DAC's website, which is DA Capital, spell that out, sc.com. I really want to thank you, Don. Really fantastic discussion today. Very timely. So I can't thank you enough. And on behalf of our DAC and also the attendees today, I want to thank you for your time today. So
thank you, Mark, and thank all of you who participated and put in such great questions. What a great honor it is to be with you. I hope we can do this again soon.
Yep. Thank you, everybody. Take care.